but I'm going to be talking, as Fabian said, about how to use data science tools to measure and to identify tax havens. Maybe just to start with the big number is that we lose 427 billions every year to tax havens. This is a big number and it's difficult to comprehend. So I usually try to put it into equivalents, and this is 40% of all corporate foreign profits are in tax havens already. Or these 427 billions are the same as 200 times the budget of the European Research Council, which is the annual budget, which is a research council that funded 5 Nobel Prizes and over 42,000 people in Europe. This 427 billions is equal to 4 times the entire health expenditure of Africa, or the same as paying the salary of 34 million nurses. So it's quite some money. And when we talk about tax avoidance and tax evasion, there's usually 2 things that we talk about that are a little bit different. And these are profits shifting to tax havens. So you are a company and you move your profits to Ireland, let's say. And this is always illicit, in my opinion, and I think most people's. And the second thing that a lot of people talk about is about non-disclosing income to tax authorities. So this is, just getting some money and non-reporting it to the tax authorities. And this is always criminal. And while we at the Tax Justice Network do research related to both of these things, for this talk, I'm gonna talk only about corporate profit shifting to tax havens. And there are 2 different ways how corporations can avoid taxes. The first one is to sell digital products from tax havens. So when I was preparing this presentation, I just went to my email and I started searching for Ireland, Luxembourg, and Netherlands, and start taking screenshots of the emails. And you can do the same. At the end of the email, you always get the details of the company that is sending you those emails. And for all these digital companies like LinkedIn or PayPal or Amazon or Slack or Google or Apple, Uber, they are always in a tax haven. So the thing is that when you buy a book from Google, like a digital book, or you pay for YouTube Premium, or pay your Slack or your PayPal, whatever premium things, you are paying not to a company in your country, you're paying to a company in a tax haven. So those profits do never appear in your country, they always appear in the tax havens and are taxed in the tax haven. So that's the first way to shift profits to tax havens, to move profits to tax havens. And this is way easier to do if you have a digital company, because well, you sell things through the internet. But even if you don't have a digital company, you can do it still. And this is the second way how companies avoid taxes, and is with intra-group transactions. And what I mean with this is that a company has many subsidiaries in different countries, and they have relationship with each other. So a company in country A will buy something from the company in country B. But these 2 companies, A and B, these 2 companies are part of the same multinational corporation. So let's imagine that you are a coffee roaster with a roasting factory in Italy and a plantation in Kenya. So your company in Italy buys 10 million in beans from your company in Kenya. Both of the companies are yours, but they need to buy things from each other. They can just not give things for free, because that's how the market works. So in Kenya is getting those 10 million in income from these coffee beans that is selling to the roasting factory in Italy, and it has some cost, like the machinery or like the labor, etc. Let's say that is 5 million. So at the end, the profit is the income minus the cost, which is 5 million, and then you would pay a tax of around 30% of it in Kenya. And then in Italy, you get the beans, you roast them, and then you sell them, and imagine that you get 20 millions from those roasted beans, because they're more expensive than the raw beans. You pay for the beans 10 millions, and then you have some other costs like the factory labor, all these kind of things. So at the end, your profit is 5 million, and then in Italy, you also pay a tax of around 30%. But let's see what happens if you add a tax haven in the middle. So now let's imagine that your company in Kenya is selling the beans to your company in Switzerland for 8 millions. Before it used to sell them for 10 millions, now it's selling them for 8 millions. It has an operating cost of 5 million, the one in Kenya. So the profit is 3 million. It used to be 5 million, now it's only 3 million, and then you pay 30% of tax on that. Then those beans or the rice of those beans are in Switzerland. And yeah, in Switzerland, nothing happens. They just sell it to Italy. And instead of selling them for 10 million, they sell them, or for 8 millions, they sell them for 12 millions. So what happens in Switzerland is that you get 12 million from Italy, you pay to Kenya 8 millions, and at the end you have some operating costs like marketing or whatever you want to have in Switzerland. And at the end you have 3.5 millions in profits in Switzerland that just appear from nowhere. And in Italy, you still have the same thing, the income 20 million from selling the roasted beans, but you have 12 million of cost from buying the beans from Switzerland instead of buying them from Kenya directly. So you also reduce the profits in Italy, in both Italy and Kenya, and then you increase the profits in Switzerland, where you pay basically no tax. And there's many ways to do this. You can, for example, buy a coffee in Italy, and then you need to pay operating cost of you need to pay the employees that are serving the coffee, the rent, the cost of the beans, all these things. But there is other costs that you need to pay when you are buying a coffee in Italy. For example, maybe the company in Luxembourg gave a loan to the company in Italy, so the company in Italy needs to pay interest to the company in Luxembourg. The trick is that both companies are from the same multinational corporation. So yeah, basically Italy is paying Luxembourg for this interest, and it can pay the Netherlands for the brand of the coffee. Or there are different ways that you can do this, but the trick is that you always reduce the profit in the place where the taxes are high, and you increase the profits in the places where the taxes are low, like Luxembourg, Netherlands, Switzerland, Ireland, Cayman Islands. So this is a really short summary of how tax avoidance work. What I'm going to be talking about in the presentation is how can we determine which countries are tax havens. And there's two main ways to do this, and I will talk later about a third one. But the first one is to look at the legislation. And so if a country looks like a duck and swims, it's going to be a duck. No? So if a country has low taxes and they have financial secrecy, and they have like a strange courts that favor the companies and the individuals, well, it's going to be a tax haven. So this is what many people do, including the European Commission. But the problem with this is that there is a lot of political constraints. So the image in the top is the list of tax havens from the European Commission. And you can see there countries like Namibia or Mongolia or South Korea. These are countries that nobody uses as a tax haven. But they are there because they were, for example, not able to comply with all the regulations. And on the other hand, there is many countries that are tax havens, like the Netherlands, Ireland, Cayman Islands, that are not in the list. And this is because the list is political more than anything else. The second option is to look at the location of profit shifted. You look at the location at countries that have a lot of profits but do not have so much economic activities. And you can also combine both of them. So you can look at the legislation, and this is, for example, what we do at the Tax Justice Network. We look at more than 100 different legislations in, I think, like around 80 countries. And then we look also at how important those countries are and put those two pieces together and create a list of tax havens. And the most important are British Virgin Islands, Cayman Islands, Bermuda, the Netherlands, and Switzerland. And this is not so much data science, so I'm not going to talk more about it, but you can always Google if you are interested, and there is like nice ways to explore the data and all these things. And what I'm going to talk is about the second way that I explained, is to look at the location of profit shifted. So if we want to know where the tax havens are, we want to know where there are a lot of profits, but there are not so much economic activities. This is some work that I did for the Tax Testing Network, but also for the International Center of Tax and Development in the UK. So the basic idea is that if you want to produce anything, you need labor and capital. Without people and without machines, you cannot produce anything. So you can look at the location of profits and compare it with the location of labor and capital, and the places that have too much profits compared with labor and capital. Basically, those are tax havens. So this is the plot that I'm showing here. In the y-axis, you have the profit per employee in log scale, and in the x-axis, you have the tax rate that companies pay in those countries. So you see countries like Bermuda, Gibraltar, Jersey, Cayman Islands, or British Virgin Islands that have an average profit per employee of $10 to $20 million. So those are really, really productive employees. I don't know how much money you make for your companies, but I don't make that much. So I don't want to talk too much about this, but part of a project that we did here was to apply evolutionary algorithms to find actually how to model this, because the main way to model this in the literature is to throw a linear model to basically this graph, a little different, but basically this graph, and say that there is a linear relationship, which is clearly not linear. But in any case, if you want to know where the profits are and where the economic activity are, what you need is data. And luckily, last year, we started having country by country reporting data. And this means that multinational companies need to declare where they have their profits, their employees, their assets, and a few other things. Where do they pay their taxes? At a country by country level. So they need to say exactly in which countries they make profits, exactly in which countries they pay taxes. And ideally, we would want this data at the firm level, but right now it's aggregated by country. So we know that all French multinationals maybe have 100 employees in Bermuda, let's say, but we don't know which company is actually having those employees. But of course, if you have data, you always have problem. And the problem in this case is that many countries decided that they didn't want to publish this data, that they were just not going to disclose it. And here in the y-axis, you have how much of this data you disclose. In the x-axis, you have how much of a tax haven you are. Doesn't matter exactly what they mean. But you see that there is many countries that chose not to report this data. And this is a huge problem if you want to analyze tax avoidance, because some of the largest tax havens like Cayman Islands, like Netherlands, Switzerland, decided not to report basically any data. So what we did for this paper was to try to impute this data. So what we want to know is, let's say, German multinationals, Germany didn't publish the data, German multinationals in the Netherlands, how much employees, how much turnover, so revenue, and how much profits do they have in every country of the world. So we do this by combining many different data sets. So data set, for example, like foreign direct investments, so how much companies in Germany invest in the Netherlands, data on taxes, how much taxes companies pay in different countries, colonial history, which is really important for investment, the distance between the country, many different data sets, like how many tax advisors are in the country. And then we use the histogram-based gradient boosting, which is basically kind of like a fancy random forest in the sense that it's an ensemble of trees. Yeah, and we use this for two reasons. One of them is because you need to worry about missing values because it's already dealt by the algorithm, which is a great advantage in our case because most of these data sets are not so complete. And if you impute the data, there is always a bunch of considerations that you need to take into consideration. And the second reason is because this algorithm was doing much better than other algorithms that we tried. So with this algorithm and this data, we calculated what the employees and profits of companies are around the world, and this allowed us to calculate profit shifting. And because there's obviously a lot of noise training this algorithm, then we did this 1,000 times, training the algorithm with different subsets of the data and then calculating everything from it. And what we got from this is this figure. So in red is where profit had been shifted to, and in blue is where profits are coming from. So profits are being shifted to Cayman Islands, the Netherlands, Luxembourg, China, Hong Kong, Bermuda, British Virgin Islands, Puerto Rico, Singapore, and Switzerland. And those are already 700 billions out of 1,000, a trillion total. And the profits are being shifted from the US, from Japan, from Germany, and from many other countries. And we show that actually lower income countries were the ones that were being affected the most. So just to show a little bit of how this imputation works and the bootstrapping process that we use. Here is the results for Germany and France. Germany did not publish data, so we had to impute a lot of the data, and because of that, the confidence intervals are pretty huge. So on the median, we estimate that 100 billions are being shifted out of Germany, but this could be anything from 0 to 200. France, on the other hand, published their data, so we are pretty sure about how much profits are being shifted out of France. And the same for the Netherlands and Cayman Islands. And these are places where profits are being shifted to. So this is an example of how we use basically data science tools to identify tax havens, identify how much money are in tax havens. So those are the two main methods, and I wanted to also talk to you about a third option that we came up with, which is basically using network science to identify which countries are tax havens. So this is a paper that we wrote already like 3 years ago, but it's based on corporate ownership networks. So let's start with Francis Canner, which is this beer company that probably a lot of you know. And this company is owned from a holding in Germany. And this holding in Germany is owned from a holding in the Netherlands. This holding in the Netherlands is owned by AB InBev, which is the largest brewery in the world, which is based in Belgium, headquartered in Belgium. Then 35% of this company is owned by a stichting, by a foundation in the Netherlands. And this foundation in the Netherlands is jointly owned by two funds in Luxembourg, EPS Participations and BRC Luxembourg. The second fund, BRC, is owned through a series of companies in Bahamas and the Netherlands by Mr. Jorge Paulo Lehmann, which is this person that has Brazil-Swiss citizenship. So what we do is to try to analyze which countries may be tax havens by their location in this corporate ownership chain. So from the left, we basically go to the right, where we just have the countries: Germany, Netherlands, Belgium, Netherlands, etc. And then we look at who is at the beginning of these chains, who is in the middle, and who is at the end. So in this case, because it's only one chain, Germany is at the beginning with 100%. And in the middle, the Netherlands is 135% of the money from Francis Canner goes through the Netherlands. And this is more than 100% because it goes to the Netherlands several times, at the beginning in the first holding and then in the foundation. 35% goes through Belgium, 17% through Luxembourg, and 8% through Bahamas. And which jurisdiction as sync, so which ones are at the end of these chains. And it's Belgium 65% because then the third company is only owned partially by the foundation in the Netherlands. So 65% of the value remains in Belgium, and then a little bit in Luxembourg and in Bahamas and the Netherlands. So we did this for 100 million companies, and we deal with some problems, for example, of circular loops and these kind of things. And at the end, what we found is that there is no one type of tax havens, but there are like basically two: the ones that are at the end of these chains and the ones that are in the middle. The ones that are at the end, we call them sinks or profit centers. These are mainly UK colonies that have no taxation, that have a lot of secrecy, and that are used by companies to avoid, companies and individuals as well, to avoid legislation and to avoid taxes. And the list of countries is British Virgin Islands, Luxembourg, Hong Kong, Jersey, Bermuda, Cyprus, Taiwan, Malta. And the ones in blue are countries that have a history of a colonial relationship with the UK, so most of them. And the second type of countries, we call them conduits or coordination centers, and these are developed developed countries. They have low tax on financial profits, so if you bring your brand or you give loans from those countries, you don't have to pay a lot of taxes on them. They are used as a conduit to this other type of countries, to the sinks or profit centers. So if you want to bring your profits to Cayman Islands, you usually go through a holding in the Netherlands or Luxembourg or Ireland. They also serve for regional management, so you put a headquarter here, or high value adding operations like giving loans or these regional headquarters. So yeah, as a summary, tax avoidance is a large and increasing problem. We can use data science tools to understand which countries are tax havens. So in the first part of the presentation, I show how we use this type of algorithms to show that there is 1,000 billion, so $1 trillion in profits in tax havens, which means that it costs us in tax revenue around 200 to 300 billions a year, because the tax rate is around 20–30% for most countries. And the second part of the presentation, I show you that there are two types of tax havens: the ones that are in the middle of these corporate structures and the ones that are at the end. And yeah, this is basically what we analyze at the Tax Justice Network. We are trying to take back control of our tax systems, trying to reprogram how the international tax system works so it favors all of us and not just a few companies and a few individuals. And just to end on a happy note, how do we move forward? How do we solve this problem? And there's two ways that we have to do this. The first one is to reform the tax system. The tax system was created in the 30s, where there were basically no multinational companies, where there was no internet. So it's completely broken. And so we have two measures that are very important. The first one is unitary taxation. You need to tax where the real activity takes place. If I'm buying a book, a digital book from Google Books, I should pay taxes here. Google should pay taxes here. Google shouldn't pay taxes in Ireland or in Bermuda. And there should also be a minimum tax rate. It cannot be that a country can put a tax rate of 0% and attract the profits of multinational corporations. And these are measures that were utopian a few years ago, but now they are being studied and being proposed by international organizations. And the second group of measures are measures to increase transparency. So this is what we call the ABC of taxation. So I want to talk too much about this, but it's basically increase the transparency, so we know where companies pay taxes, so we know who is owning these companies, so we know who is owning the different bank accounts. And yeah, if you have any questions, or you can ask me now, but you can also contact me through Twitter or email or whatever you would use. Yeah, thank you.
Awesome, excellent. Thank you, Javier. I think there were already some questions in the chat. I think, Gil, you were first. Do you want to ask a question, or should I just read it?
Well, I can ask it myself. About the gradient boosting algorithm that you used, you said it performed best, but what is your performance criterion? Because I guess you don't know the real truth about these imputed values. So
yeah, so we use the countries that do publish the data, and then part of it we use it to train and part of it to test the data. So we do know the truth of part of the data, and we have part of the data that we do not know the truth. But yeah, in a few months they will publish a second round, and more countries will be included. So hopefully we can.
then you can really check whatever you're doing good. Okay. Thanks.
Okay, Mirza, do you want to ask your question?
Sure. Hi, Javier. Thank you. Very interesting talk. So I was just wondering, have you tried to see what kind of an effect does it have for companies with the same scale and same impact and influence, for one company not making use of tax havens and the other one not? How does that affect the, let's say, the performance of the company, the employees, the wealth being distributed in that country that they operate, or the employees? How does that? I'm not being the advocate's devil here, but I'm just trying to understand what does tax do actually?
Yeah. Well, the answer is a lot. So you cannot do this because there is basically not two companies or companies with the same size and scale where one of them uses tax havens and one of them doesn't. Like most companies use tax havens, and from the biggest companies, which are the ones that are responsible for most of the tax avoidance, all of them use tax havens. So you cannot do that, but what you can see is that a lot of the profits in these companies are in tax havens, and those profits are not made in tax havens, they are shifted there artificially. So if those profits were actually in the countries where they belong, they would pay a lot more taxes. So to just give you an example, let's say which one. Apple paid 5% tax rate on their foreign profits. There's no country where they can pay 5%. Like the Netherlands is 20 something, in Germany is so around 30. So yeah, there's a huge difference between what they should have been paid if they were paying taxes where they have their economic activity and what they actually pay.
I understand. Wouldn't that, or maybe there is not enough time, otherwise at the end I can continue asking or have a discussion. Thank you.
Awesome. Bart, do you want to ask a question or should I read it? Okay. He says, I don't understand the minimum tax rate. Is a minimum required or just a worldwide equal tax rate? Yeah,
I went pretty quickly through that because I didn't want to take too much time. But it's a minimum tax rate for every country. So what it's saying is that if a company is in Cayman Islands that doesn't have, and the tax rate in Cayman Islands is 0%, so if they put $1 million in profits there, they need to pay 21% in taxes. Doesn't matter that the tax rate in Cayman Islands is 0%. Another country will be getting those taxing rights. So that's what a minimum tax rate means, is that they need to pay at least this minimum tax rate, like 21%, in every country where the company operates. And this is something that Joe Biden has proposed for US multinationals and also the OECD, and it's something that is most likely going to happen within the next year or 2 years. It's a really good measure.
On that note, I think Maya.
Yes, I think you just answered my question. My question was how hopeful you were about the new discussions of OECD and the G7, but I guess you say this will happen soon, so that's good.
Yeah, I really hope that. I really think it will happen. I mean, at Tax Justice Network, we are pretty critical about the entire process because it still privileges rich countries over poorer countries. Even when every country was consulted for this reform, poorer countries were not really able to contribute and to put their ideas on the table. So what they are trying to do now is that the company in Cayman Island that is now paying 0% taxes will have to pay 21% taxes, and they will have to pay those 21% in taxes to the headquarter country, to the US in this case, if it's an American company. Which this means is that if you see profits from Kenya to Cayman Islands, the US is going to collect the taxes that are due, not Kenya. So we are pretty critical because of that. But
so that would basically mean is shift towards where headquarters are. So it's still often the same countries as it is now.
Yeah, exactly.
Okay, well, that's less optimistic then. But thanks.
Good. So I have one question. You mentioned that we only have country by country reporting data, and ideally we would have firm level data. Is this something that is down the line, or are there sort of methods that try to infer this? What's the status there?
Yeah, so this is something that already happens for banks and extractive industries in the European Union, and now it's been discussed in the European Union for all large multinationals. And it seems that it may pass. It's still dependent on one or two countries switching. For example, Germany seems to be not very positive about it now. But this is a huge thing that needs to happen, that every company needs to publish where they pay their taxes, where they pay their profits in every country in the world. Because this is not like a corporate secrecy. This is just, an act of transparency. It doesn't affect competition. It's just transparency.